Creme Wealth Management, we come with no pretense. Financial advising, making money make sense.
Thank you for joining me today. I wanted to take some time to discuss how we should look at preparing for upcoming election cycles, as we have one right around the corner here. So are they things that we should be worried about? If so, what can be done about it? We're going to get into some of that today and just go through it all. So to start, there is a scary reality that exists today, and it happens when we get on social media. It happens when we look at the news. And that scary reality is that this country is very polarized. In fact, here's a study that Vox did, which shows that the U.S. is now at the most polarized society that it's ever been, according to them. And, there's a lot of that going on. You can't say what you believe without being attacked. And a lot of people are really frustrated right now. So what does this mean for the economy, for the stock market in particular? So we're going to take a look at that, because this is a scary situation. But we want to approach scary situations with the approach that we're going to be the light in this situation. And we're going to try to continue to show what we should be afraid of and what we shouldn't be afraid of, and then how we should approach everything either way. So, the reality is that right now, people don't feel safe. There's an overall feeling of unrest. Protests are happening all over. Police officers are being accused of discrimination and murder. Lots of people are being called racists, and we will probably have to fight overseas in Asia if we continue on this course. And don't even get me started on Russia and the shenanigans that they're up to. And it feels like the rich are only getting richer. The S&P is up by 181%, and we still have to get the troops home. I mean, there's so many issues. Things are so bad right now, I wouldn't be surprised if someone tried to assassinate the president. In fact, they actually did. And then they assassinated his brother 5 years later, the same year that Martin Luther King Jr. was assassinated. So when we look back and everything that I was just saying, it sounds like it's today, but in reality, that was the 1960s. So have we been through this before? Yes, in a way we have. So let's look back in history and see where we've been, where we're going, and what we can learn from it. So I did a study. I pulled all the data all the way back to 1948 and looked at every election cycle starting with Truman. And the reason why I said 48 was a good starting place is when we go before that, we're into the World War cycles. And I think there's going to be a lot more volatility and variability really during those periods. So we'll start and go a time traveling exercise starting in 1940s. So 1948 to 2016, these are the years we're going to look at. And starting on the left-hand side, you'll see 1948 candidates who won on the top. So in this example, it was Harry Truman. Dewey was the Republican runner-up. And the Senate this year was controlled by Republicans. The House was controlled by Democrats. And we'll see in all these different years, we're going to have a blend. We're going to have some years where the president was a Republican and House and Senate were Republican controlled, and some years where the president was a Democrat, and some year in the House and the Senate were Democrat controlled, and a blend of both. And we'll see on the right-hand side what's happened in those years and what happened to the S&P 500 during that time. And keep in mind, the S&P 500 is specifically an index of the 500 largest U.S. companies. So in this example, 1948, what happened in 1948? Well, We had the Marshall Plan, where 15 billion was authorized in aid to 16 different countries. We had the Berlin blockade beginning, kind of start of the Cold War. We had the second peacetime military draft. So obviously we don't have drafts anymore, and this was a time where there was a lot of fear and unease because of everything that was going on with Russia. And during this quarter, so we looked at the fourth quarter in particular, so October 1st through December 31st, the S&P 500, the 500 largest U.S. companies, went down by 5% during that quarter. So that's what happened in 1948 overall, and then what happened in the market in that quarter. So the next year we're going to look at goes into the 50s. So 1952, Eisenhower won that year. He was the Republican winner. The House and Senate were split controlled. And in 1952, we got into a lot more wars during this time. We were fully into the Cold War, the Korean War, and there was a steel strike that happened in 1952. Interestingly enough, Truman had nationalized all steel mills in the U.S. just before this strike. So it was the government taking over an entire sector, which is pretty incredible to think about that happening today. But what happened to the S&P 500 during this time is it went up by 8%. 1956, Eisenhower won his reelection, but now we have a Democrat-controlled House and Senate. So what was going on in 56? Well, we had the Montgomery bus boycott, as you had busing that was starting to happen in some communities in the U.S. We're still in the Cold War. And I thought it was interesting, and this year is when Eisenhower had authorized "In God We Trust" as the national motto, and also authorized the phrase "under God" to be added to the Pledge of Allegiance during this time. So those things were actually implemented in 1956. And the S&P 500 went down in the fourth quarter by 2%. And now we're back into the 60s, kind of where we started with that story of what was going on. In 1960, we had John F. Kennedy was elected president. We had Nixon as the runner-up during this year, and a Democrat-controlled House and Senate. So all two branches, Article 1 and 2, I believe, would be controlled by Democratic Party. 1960 happenings, where we had the Cuban Revolution, we had Vietnam and Cold Wars, and the Civil Rights Act of 1960. And then the Civil Rights Act of 1960 was a law that established federal inspection of local voter registration polls, as people were being forced to not be able to exercise their rights. So the S&P 500 during this time of turbulence, went up by 11% this year in 1960. 1964, Johnson was elected as a Democrat president, House and Senate, Democrat controlled. And what was going on in 64? Well, now we have the KKK and race riots, and Martin Luther King Jr. Was also, marching and bringing a lot of his ideas to the forefront of society, advocating for civil rights, as the Civil Rights Act of 1964 was signed into act, which abolished officially racial segregation in the United States. And during this time, the S&P, the market, went up by 1% this quarter during this election cycle. So we'll see 1968. Now we have the year when Nixon was elected. So what happened in 68? Martin Luther King Jr. was assassinated. Robert F. Kennedy, so former President Kennedy's brother, was assassinated. Still in the Vietnam and Cold War. And we are at a peak with troops in Vietnam at this point, 549,000 troops in Vietnam. In fact, over 3 million troops deployed worldwide during this time. And what did the S&P 500 do is it went down by 2%. 1970s, time of peace and love, right? So 1972, Nixon won his reelection, which was kind of interesting since Watergate had happened before his election. Vietnam and Cold War still going on. Troops withdrawn from Vietnam at this point, signaling kind of the end of the Vietnam War. And S&P 500 went up by 8% during this fourth quarter. In 1976, Carter was elected. And what was going on in 1976? So Sarah Jane Moore was sentenced. I thought it was interesting. I didn't hear of that name before. So she was the would-be presidential assassin of Gerald Ford. The Cold War was still happening. And here we have the Escambia, I don't know how it's pronounced, maybe that's it, high school riot. So a 2,000 student racially charged riot in Pensacola, Florida, where 30 students are injured in a 4-hour fray. So not quite the peace and love that was going on in maybe other parts of the country. Bottom line, what happened to the S&P 500? It went up by 2% during this quarter. So hypothetical growth, this is just an example to show you the S&P 500 you could look at as the red line. So this is 1970s, and you see how there was a lot of volatility where it came up and went right back down between the period of 1970 and 1974. And then there was really some more growth in the market. And you see that if you were 100% aggressive in the S&P 500, then your $1,000 would have turned into 1767 at the end of this 10-year period, or otherwise it would have gone up by 76, almost 77%. But if you had a little bit of diversity in that portfolio and had some fixed income and things that help weather the storms a little bit more, that portfolio would have actually gotten a higher return, maybe somewhere as high as 82% in a more conservative portfolio in this example. So just to kind of give a perspective of the whole decade of what this would look like for the market perspective. Into 1980s. In 1980, we have Ronald Reagan, who won the election. In the happenings of 1980, well, we were in a minor recession. There was a 7.8% unemployment rate, which is not too far off from where we are today as we sit now at the end of September. Chrysler company at that point was bailed out with a $1.5 billion loan. And the Iran hostage crisis was going on in addition to the Cold War. So during this time, S&P 500, even with this minor recession and everything, goes up by 2%. And I'm hoping you're starting to see some cycles here where maybe there is a lot going on and it sounds very turbulent, and you'd expect that number at the S&P 500 change to be down or horrible, and it might be higher. And some years where it's relatively low activities going on, it seems fairly innocent kind of a year, and the market goes down. So it's hard to know, and we'll get to that kind of the end of all this, but just keeping in mind some of the cycles with that. So 1984 candidates. So we have Reagan, who won his reelection. We have 1984 happenings. So Reagan had put a chemical weapon ban in place. He expressed that he wanted to go against that since it was becoming part of world kind of conflicts that chemical weapons were coming into existence. There was more of a focus on internal, focus on the war on crime, urban crime, crack epidemics were happening in inner cities. And we're still in this Cold War that's going on, fear of what Russia's doing. S&P 500 goes up by 4% during this fourth quarter of 1984. 1988 is when Bush 41 won. In 1988, there was a low unemployment rate, relatively low at that point at 5.3%. And we're fully in the country into the war on drugs, changing some of the legislation around mandatory sentencing limits and things like that. S&P 500, fourth quarter, goes up by 3%. And now we're into the 1990s and kind of the Wall Street heyday going on. So we've got Clinton is elected in 1992 as the winner. And what's happening in 1992? Well, we've got Rodney King on the news being beaten by those police officers in LA and the riots that ensued across the country that happened from that. Actually, the 1992 Los Angeles riots had 53 deaths and $1 billion in damage, if we think back to that point. So unemployment was getting a little bit higher, 7.8%. And the Cold War had officially ended. And throughout all that, the S&P 500 went up by 6% in that quarter. 1996, Clinton wins his reelection. And what happens here, we have the Iraq disarmament crisis. We have unemployment dropping down to 5.1. And the first middle school shooting that I found in any of these election years happened in Moses Lake, Washington, at Frontier Middle School. S&P 500 during this time goes up by 9%. And then we go into the 2000s, which was a decade riddled with trouble for the markets. So it started off by happening, Bush 43 took office in 2000, and we had a dot-com bubble. We had Y2K happening. We had unemployment at fairly record lows right before all this. Microsoft was going through antitrust case at that point, as you know, the government thought that they were too big and controlled too much. A lot of it had to do with having their own operating system and things like that that came pre-installed, and or their own web browser. The S&P 500 went down during 2000 fourth quarter by 4%, and then 2004, and it continued down from that point on after the dot-com bubble burst and everything like that. 2004, Bush did win re-election, that disputed election result. And here was one of the few time periods in this cycle of a fully Republican-controlled president, House, and Senate. And what was going on in 2004? Well, we had same-sex marriage in the U.S. That was legalized. We had New York City protesters around a lot of that. We had Afghanistan-Iraq war happening in 2004 after 9/11 happened in 2001. And throughout all of that, we have a 6% increase in the S&P 500 in the market that quarter. 2008, President Obama is elected, and now we have kind of the reverse situation. We have a Democrat-controlled president, House, and Senate. And what happened in 2008? Well, we know that the housing bubble started, the Great Recession, unemployment was up to 10%, 11%, still in the Iraq-Afghanistan war, and S&P in this quarter was down by 11% because of these things, particularly the housing bubble and the Great Recession. So if we look at this whole decade, just like we looked at the 70s, we can see it doesn't have quite the volatile beginning that the 70s did. It does have a slow decline over the first 2.5 years there, once Y2K happened and the tech bubble, and then 9/11, and then everything came back up, and then we had this sharp decline in 08, 09. Again, The bottom line, kind of that darker orange, would be more of the equivalent of an S&P 500 exclusive portfolio, where we see that $1,000 at the beginning of 2000 would have turned into $909 at the end. Wouldn't have been a good run to be just in the S&P 500. The income-based portfolio, which is just bonds basically that produce income, would have been the winner for this 10-year period. And then the blend in between the two really shows that you can still mitigate even a horrible 10-year period. And if you were in something like a conservative growth, or it's a moderate growth, maybe somewhere in the middle where you're 60% in the market, 40% in bonds, even in this horrible 10-year period, you would have had a 43% return on the money over that time frame. So 2010s. So 2002, President Obama was reelected, and now in 2012 we have the Dow coming back. You know, Dow's another market index similar to the S&P but more limited. It was back to the 08 level. So it took 4 years for the stock market to come back, as we saw happens in cycles. And what was going on? Well, everyone was glued to the TV watching Casey Anthony's trial, and then Trayvon Martin, George Zimmerman. And well, we had Obamacare being put into place, the Affordable Care Act, and the Afghanistan war still going on. All of this, S&P 500 goes up by 3% in this quarter. And then we go back to 2016. Not too long ago, President Trump was elected, and here's another example of a Republican-controlled House, Senate, and presidency. And what do we have? Well, we have a lot of shootings and death. That was the best way that we could kind of describe 2016, because in this year we've got the Pulse Club in Orlando shooting where 49 people were killed, 53 wounded. It surpassed the deadliest attack in the U.S. since Virginia Tech. We had Vegas shooting as well, and it was investigated as a domestic terror attack. And then we also had Black Lives Matter protest in Dallas, Texas here, with a sniper opening fire and killing 5 police officers and injuring 11 more. So I'd say it was a pretty brutal year on shootings and death. We had anti-Trump protests, a lot of women's marches and things like that. We have a lot of focus on abortion clinics as well during this time, partially because a lot of material had come out against Planned Parenthood and what was going on kind of behind the scenes. So just a lot of turmoil in 2016 overall, a lot of which happened in the last part of 2016. And during that time, the S&P 500 still went up by 6%, amazingly. And here we are today, 2020, and we've got Trump running against Biden, and a pretty horrible debate that happened last night. That was pretty tough to watch. We've got the Senate, which is currently controlled by Republicans, which is one of the talking points about the Supreme Court nomination. We've got the House controlled by the Democrats. And what's happening in 2020, COVID-19 is obviously a big part of what's happened in 2020. We have $2 trillion in stimulus and maybe more to come. We had 10.2% unemployment in July of 2020. It's now somewhere around 3% less than that as we sit today. We have a lot of Black Lives Matter protests. They're happening across the country. S&P 500, we don't know what's going to happen to the fourth quarter, but the S&P 500 second quarter, we had one of the greatest quarters of all time because we had one of the largest drops of all time as well, the largest drop of all time since 1987. And that quarter bounce back of second quarter was up by 20%, which is pretty incredible. So what's kind of the summary of all this? Going back to 1948, this was 18 election cycles. Looked at rotations where there was Democrat-controlled presidential times, there was Republican-controlled, and both of those, sometimes there were Republican-controlled House and Senate, sometimes Democrat-controlled House and Senate, sometimes a blend. All of it was in there. So what was the averages, and what can we kind of gain from looking at this? So over 18 different cycles, if the incumbent won, on average, there was a 4.7% growth in the S&P 500 in the market. If a Republican won, there was a 3% growth in that fourth quarter on average. And if a Democrat won, there was 2.1% growth on average. So overall, if we take the 3 and the 2.1%, we'd say there's overall 2.6% growth average, plain and simple. Of the years, so 18 cycles, how many of them were negative? So we can't say it's always going to be positive 2.6%. That's an average. Some years are up, some were down. We saw 28% of the time it's negative, and 72% of the time it's positive. But when we look at those numbers on the right-hand side, we say, well, wait a second, 2.6% in a quarter growth and 28% chance of negative returns. Where have we seen those numbers before? And interestingly enough, if we look at 1948 to 2016 and take that 2.6% fourth quarter and annualize that and say, well, it's 10.4% annual return. Since inception, the S&P 500 since 1926 through 2020 has returned 10.22%, which is pretty close to that 10.4%. So what that says to me is, from a return standpoint, there's really no difference between an election fourth quarter cycle or any other time in the S&P 500 on average. But what about the downside? So we've got 28% chance of loss during these election cycles. Well, is that higher? Is there a greater chance that you'll have it down? Well, if we look at the same 1948 to 2016 and compare apples to apples, there's a 26.5% chance just being in the market that you'll have a loss. And what we always say is 1 out of every 4 years, you're going to have a loss. That might be 1 out of every 4 years. It might be 1 day out of every 4 days. You have a downtime in the market. So it really depends, but either way, these are identical, more or less, 28 versus 26.5. What this is saying is that you're going to be in the S&P 500, have the same gains, same loss chance as any other time, regardless of whether we're in an election cycle. And here's the interesting thing. So this is a matrix from 1940 to 2019. And it shows here on the far right-hand side, we've got an 80-year look. So we just talked about just the S&P 500. But what if we actually put in some fixed income and built more diversity in a portfolio? Well, is there still as high of a chance of negative returns? And if we look on the right-hand side, all the way over there, that 80-year column, so the last 3 columns on the right, it shows all the way at the top is 100% in the S&P, 0 in bonds. There were 18 years of negative returns during 1940 to 2019. So 18 years where the market returned a negative return over that year. But if we go all the way down to the 90% bonds, 10% in the market, there's only 4 years with negative returns. Now, granted, your average return from a growth perspective is going to be much lower once you put in that fixed income. But the point I want to illustrate here is yes, there's some risk, but we can mitigate risk by not just comparing to the S&P 500, but by feathering in some investment options that can help mitigate and keep it from going down as much and provide that kind of airbag in a portfolio. So what are the takeaways? So takeaway number one here is, the thing we can say is that risk and returns are the same, whether it's an election cycle or not. But obviously, emotions are heightened. The news is really on this. And part of the reason why there's so much focus on the market right now is that, interestingly enough, the market, the 3 months prior to the election, actually predict who will win, predicts if the incumbent will win more often than not. So if we have 3 good months and positive return running up to the election, there's a good chance the incumbent will win. And if there are 3 bad months, there's a good chance they won't win. So that's why there is a lot of view on what is the market going to do. So what can we do overall to prepare? So, well, here's one thing. We know there's going to be more than likely one of these 2 outcomes. It's possible we could have Libertarian, Green Party, but more than likely it will be one of these. So what can we do? Well, we can look at both candidates and say, well, what is the differences in their tax policies? So this is looking at Biden and Trump and saying, what are some takeaways that we could say, how can we think about taxes in the future and try to protect against that? So we see that for the most part, the top individual tax rate isn't that difference between the 2. The small business tax rate is a lot different. So right now, small businesses have a 20% across the board deduction that takes place that Biden wants to repeal. So that would be something to think about, and we'll get to that. But for the individual investor, the capital gains rate is being moved from 20% to 39.6% if Biden wins, but only for $1 million or more of income. Who's this mostly going to impact? Well, this is going to mostly impact small business owners, in my opinion. So these are people that have a business or something like that with a large capital gain over $1 million that forces your income up, and that's going to hurt a lot of the transferring of business equity into retirement plans or into other generations. So that's something that we'll want to keep an eye on that may apply to some of your situations. So itemized deductions, where Biden's looking at maybe capping some of those deductions at a 28% tax rate. Overall, what are some of the major things that might impact the majority of people? Well, the first one is wages on Social Security. So right now, Social Security, you're only taxed on the first $137,000 or so dollars that you make. That goes to Social Security. If you make $200,000, the additional $63,000 or so, you're not paying Social Security tax on that. You're still paying income tax, but not Social Security tax. Well, under this plan, Biden would extend that, and wages all the way up to $400,000 would also have the additional Social Security tax put into place. So that's a really meaningful piece that will impact a lot of people. There's other pieces that we can kind of dive into, but just keeping an eye on taxes, it's something that we can do. It's something that we can look at as that comes. The nice thing is that none of this is going to be immediate no matter what. There still needs to be congressional approval. So we have time to plan around these things and keep an eye on things. So key takeaway number 2 is both candidates support spending in very different ways. And there's a lot of interesting pieces out there that show what each of them do believe in. What I did here in this slide is I said, well, what are things that have a dollar amount associated with it? So we can kind of look at that. Joe Biden believes in minimum wage raises to $15, for example, where President Trump believes in cutting payroll taxes to boost paychecks. So there's a lot of little things in there that are very meaningful from a spending perspective. So some of the ones that I want to really focus on are $2 trillion in green investments that Joe Biden is proposing, as well as $750 billion to bolster Obamacare, the Affordable Care Act, ACA, and then $2 trillion to 100% clean electricity program. And Medicare starting at age 60 is also pretty meaningful. So those three things, though, $2 trillion, and 750 billion is a lot of money. So where's that going to come from? Most likely taxes. But in the market, there's some things that we could look at this and say, well, who are the winners potentially and who are the losers potentially, depending on who wins. So if Biden were to win, we could extrapolate that green companies would be winners, given all the funding that would be behind that and the pressure on going that direction. Healthcare companies also with the Obamacare stimulus, and then international markets and some U.S. markets. I would say mostly larger U.S. companies or ones that fall under the green, eco-friendly would be on the winner side. If Trump wins, who would be the winners? Energy companies, I believe, would be more of a winner under that because it's just more of the current fossil fuel base that would be continuing. Small companies, I think, would also be considered a winner. They'd still continue to receive the 20% flat deduction, and some of the pressures would be off them from a green standpoint. And overall, I think the U.S. markets would continue to overall do well, as opposed to international in this case. And auto manufacturers as well would have a lot more flexibility under a Trump presidency. So key takeaway number 3 is, in spite of their differences of the candidates, investors should stay invested. And when we look at the different swings that we've had in the market, as recent in this example, so it doesn't have COVID on here, but we have the trade war with China in 2018. We saw that the market went down by almost 20%. And then over the next 12 months, it came up by 37%. So what we see is that by staying invested, you're able to get more money overall because you're able to participate in the upswings that continue afterwards. And you don't, as Dave Ramsey says, jump off the roller coaster at the wrong point. And just to illustrate this, over the last 20 years, 24 of the 25 worst trading days were within 1 month of the 25 best trading days. So yes, if you could get out potentially and miss the 25 worst and get in just for the 25 upswings, that'd be great. But the reality is that we don't know when that happens, and more often than not, you miss the opportunity, you get in at the wrong time. So we just say stay invested. Because here's the other piece is investors are irrational. And when people want to buy, it's when you're in that euphoria, that thrill, that back 2 years ago when everyone wanted to get on Bitcoin and it was already valued at $18,000, right before it crashed. So the thing is, we want to buy at the point of maximum financial opportunity, which is when everyone's a little bit depressed and scared. That's when we want to buy. Back in March was when we wanted to buy, right? When the markets are down and people are worried. As Warren Buffett says, we want to be greedy when others are fearful and fearful when others are greedy. So key takeaway number 4, if you feel something must be done in order to be more confident, please call and discuss strategies that make sense in your situation. Everyone's situation is a little bit different, so have an advisor to speak into that and just give you some guidance and help you understand what you can do, what you can approach it, and take some control, which goes into key takeaway number 5, to control the controllables. You can control things like tax planning. You can control things like the allocation, as we saw that the more risk you take in 2000 to 2010, you might not have been as well off. So we can take a little bit less risk if it's still part of the overall long-term plan. And then just have a good plan, have a financial plan that's aiming out for 20 years, because the longer you look, sometimes the less important the today really matters. So the takeaway of what should I do, we'll give you some real tactical advice here. So I love this quote by Dave Ramsey. He says, the bigger the pile of cash, the less you have to think about money. And the less you have to think about money, the more you can concentrate on the things that matter. 100% agree with this. So what can we do during this time? Well, number one, build your emergency fund. If you don't have an emergency fund, build it up. If you have an emergency fund, make it bigger. By doing that, it gives you what's called in our industry dry powder in the future, which means that you have the ability to buy and execute when and if the markets do go down. So if you want to take control of this situation, number one, build your emergency fund. Number two, stay diversified across the board. Don't try to go all in Tesla. That might work, it might not. So just stay diversified, have a long-term plan. Number three, invest in socially responsible funds, if that's your worldview. So we saw that some of those things that Biden is running on may benefit those companies, and that's great, but we don't want to shift our strategy just to try to play the market or play the odds. But if you really do believe in socially responsible investing, we can talk about integrating that, as we have a lot of options in that, but we want it to fit your overall investing philosophy and not be just a way to game the market. Last piece is have a financial plan that includes tax planning. Tax planning is so important. We always want to keep an eye on that. So just really work on that piece and see if there is any way to optimize your overall outlook by saving monies and taxes. I'll leave you with this. So this is my niece, Grace. She's a world class, a national ranked archer. And when we think about archery, there's a right sight picture and a wrong sight picture when we're thinking about how do we hit the target. If all she did was focus on putting the arrow in place, getting it lined up, picking the right arrow, figuring out titanium versus the steel and the flexibility of the shaft and all that, she would never hit her target because she's focused on the wrong thing. She's focused too much on what she can handle with her hand and mess with, and less about her long-term goals, which is the target. And the way you hit the target, obviously, is you have to focus on that target, still have the right pieces in place, but make sure you're focusing on the target. So I'll leave you with the fact that we should all be focusing a little bit more on the target and a little bit less on the right arrow to pick these days. So if you have any questions, please let me know. Feel free to give me a call, send me an email, whatever's easiest for you. Would love to help any way I can. Have a great day.